We're here in Monte Carlo for the Rendezvous de Septembre. For AM Best TV, I'm Richard Banks. And I'm joined now by Stefan Holzberger, who's the Chief Rating Officer for AM Best. Stefan, welcome.
Thank you, Richard.
So Stefan, one of the big topics here in Monte Carlo has been the change in risk appetite. What are you hearing on the ground about that?
Yeah, sure. So a lot of talk has been driven on the idea of reducing property cat exposure. And it's not surprising that a lot of reinsurers that are followed by AM Best that are here at the conference are kind of looking at that volatility over the past 5 years, are looking at increased climate risk and the implications on frequency and severity really across the globe. They're looking at kind of that investor sentiment when it comes to that volatility and just the difficulty that the market has had of achieving or exceeding its cost of capital on that front. So we are hearing a lot of talk about a pullback on property cat, but I think it's important to kind of dig into really where that pullback is going to be coming from. It's really looking at the working layers, that kind of 1 in 10 year return period where you tend to see a lot of the volatility. And what we're hearing from our clients is, that's really not where they want to participate. They want to participate really where reinsurers should be at the higher levels, a little bit lower frequency, really kind of protecting against that, more remote, more severe, hurricane or other peril event, which is really where the reinsurers are meant to be playing. So it's not kind of a blanket statement about reducing that footprint around property cat, but playing more strategically in those higher layers, reducing kind of aggregate exposure and, kind of some of the activities that you see as the market is hardening.
So we're seeing in terms of rebalancing portfolios, a reduction perhaps in some of the Nat Cat exposures. Are we seeing perhaps a pickup in other exposures?
Yeah, absolutely. I'm glad you brought that up. There's a lot of interest around specialty E&S casualty lines. And, it's kind of interesting to think about the rationale between kind of coming away from some of the property cat. Obviously, the modeling uncertainty has implications there. And it's not so much that casualty is a great line of business for modeling, but there's just this feeling that the underlying rates are adequate. You do have that specter of social inflation and what that might mean as the courts pick up kind of on the back end of COVID and we start to see some more large jury awards. But I think at AM Best, we do believe that specialty, casualty, E&S, those underwriting margins are true, pretty sound underwriting profitability. So those insurance groups that have the ability to toggle maybe back and forth between the property cat as well as more the casualty specialty lines of business, whether it be on the reinsurance, as you know, many of them have strong primary platforms. And it really kind of ties into a theme that we've been talking about for a long time at AM Best at many Monte Carlo events, and that's the benefits of scale and diversification, right? Those organizations that are have the diversification where they just don't like the loss experience that they're seeing in a certain line of business, that they can put that emphasis on other lines of business. And it could be other geographic areas. It could be life versus non-life, primary versus reinsurance, or property versus casualty. That ability to pivot to where the best margins are while not completely exiting, right? Because at the end of the day, it is a relationship business, and the reinsurers, to remain relevant, they have to continue to provide a service to their primary insurance clients, but to kind of in a subtle way put the emphasis where the best margins are. I think that's really where you see those top reinsurance groups succeeding during hard, or very, I should say, difficult market conditions.
So you touched on the cost of capital. How does that influence the decisions that are being taken, and what's the general outcome there?
Yeah, when you talk about the challenges for the reinsurance segment, it's not so much risk-adjusted capital, right? Based on our model, solvency capital models are all showing the global reinsurance groups in a very strong position. But when you kind of peel that back and you go to the next area of focus being operating performance, you notice that the market has really struggled to achieve its cost of capital. And, that is kind of back to what I was talking about in terms of the climate risk and the likelihood of increased frequency and severity of primary perils as well as secondary, producing really sizable losses for that business. So, kind of that spread of risk. Back to what I mentioned about the investor expectations around returns. In order to achieve returns at or above that cost of capital, you need to have a diversified book of business. And if the wind doesn't blow in the Southeast in the United States, we're halfway through hurricane season currently, but that means there's another half of that season to go. So we're all kind of fingers crossed that we don't have a big event, but it does go to show that if you've got too many eggs in one basket, you've got too much capital allocated towards that volatile property cat, it's going to be hard under the current conditions to achieve the kind of returns that investors and other stakeholders are looking for.
Well, let's talk about investors. Let's talk about investor appetite for insurance risk. What are we seeing there? It's not perhaps what we've seen in the past.
No, it's true. I mean, a lot of that comes down to or is focused on ILS and, that kind of investor appetite in terms of alternative capital. It's kind of plateaued over the last couple of years. And, from that perspective, you do have some concerns around trapped capital, around the model uncertainty. And then, you also, from the investor standpoint, you see rising interest rates, kind of slowly rising interest rates, and perhaps some opportunities in other asset classes other than insurance risk, right? But kind of coming back to that investor interest in insurance as an industry, again, that kind of property cat focus, you could say, is a little bit out of favor. I'm sure investors are quite keen on what they're seeing, again, back to those more profitable lines of business, whether it's E&S or specialty. Many of the casualty lines have seen compound rate increases in large markets. So, there's this understanding that, and those rate increases might be leveling off, but there isn't really any sign of softening where they might be kind of heading back down in the wrong direction. So I think investor sentiment around certain areas of the insurance industry is quite bullish. It's just a question of whether the reinsurance groups have that kind of platform to accentuate those classes today.
Stefan, thank you very much indeed for joining us on AM Best TV.
My pleasure.
For AM Best TV, I'm Richard Banks.